Shares in BCE taking a hit right now, hitting an 11-year low. It's among the worst performing stocks in Toronto right now. The company, which is the parent of BNN Bloomberg, is buying a big provider of fiber optic internet services in the United States. The price is $5 billion plus the assumption of $2 billion in debt. That's in Canadian funds. BCE also says it won't raise its dividend between now and the end of 2025. Let's get more from Rebecca Teltscher, portfolio manager at Newhaven Asset Management. Great to see you.
Nice to see you.
What do you think? You own BCE. It looks like investors are not delighted initially anyway.
Yeah, it's been a rough run this year with BCE. I think today's stock movement may be a little bit of an overreaction. I think investors are disappointed, and I think the communication was poorly done in terms of what they've been doing. So when initially they sold their stake in MLSC, I think it had provided comfort for investors knowing that the dividend was safe and that they're going to start delevering their balance sheet. And then here they go and do this transaction today. Obviously, if we knew that they were going to use those proceeds to be buying something, maybe that would have been better communicated in terms of investors would have a better idea of what the funds were going to be used for. But if I take a step back, and I forget about the disappointment in terms of today's news or the unexpected transaction, here's what I'm seeing. So they sold MLSC. It was a highly valued, they got a very good price for it. And it was, cash flow neutral in terms of the cash flow generation that they were providing. And in turn, they're using those proceeds to purchase an asset that they believe it will be accretive on a cash flow basis. It's actually going to help their debt metrics in terms of a debt to EBITDA because this asset is producing more EBITDA. And they look at it as it's going to, there's going to be geographic diversification in an environment that's less regulatory intensive. So, if we just look at, what they sold to what they bought, I think this is net positive. And then if you look at what's happening with the dividend, just 2 months ago, there was speculation that they were going to cut the dividend. And now they're not talking about cutting. They're actually just talking about maintaining. And, with the stock price today, it's almost a 10% dividend yield. So how much growth do you expect on a stock that yields, 8 to 10%? But, just 2 months ago, they were talking, investors were speculating a dividend cut, which is no longer on the table. So, as much as it's disappointing in terms of the communication of this transaction and how it was unexpected, I am looking at it as a slight positive in terms of what they sold versus what they bought. And, management seems very positive on the growth prospects of this asset and versus the growth prospects of MLSC.
Okay. And interesting as well, Desjardins saying this is in a way, or looks like they're expressing a lack of confidence in profitable growth in Canadian telecom. And of course, we have seen prices coming down in this market.
Right. So, and again, when it comes to the Canadian telcos being an oligopoly, there are periods of time where the incumbents play nicely and, and there's periods of time where they're more competitive. We happen to be in a period of time where prices are more competitive. Obviously, if you have a short-term time horizon, this is a negative for, the telcos. On a long-term basis, we do think the pricing environment will, regulate and get back to normal. But, this provides them with a diversification of getting away from the regulatory environment that seems to have been, hindering them, at least recently. So it kind of gets them away from that. And then there really seems to be more of a growth opportunity in terms of the fiber market in the U.S.
What about fertilizer? The Belarus president, Mr. Lukashenko, apparently wants his nation and Russia to coordinate potash price cuts, and the fertilizer stock's doing well today.
Yeah, so we own Nutrien.
Or I should have said output cuts. Sorry, carry on. Sorry, Rebecca.
That's okay. Okay. Yeah, so we own Nutrien. Obviously, it's positive news today in terms of the stock price. In terms of whether those actual output cuts are going to happen, I think it's too soon to tell. I think the signaling is positive. The fact that you have, Belarus and Russia wanting to engage in talks about production, cuts for the first time in over 10 years is a positive. Maybe it's a sign that prices have bottomed. I mean, we saw, with an overproduction of potash prices, these producers were really suffering. For us, with regards to owning Nutrien, we own Nutrien more for the retail side, and that's less talked about because it's not as exciting as the commodity side of the business. But the retail side of the business, on a long-term basis, they provide agricultural products, which we believe just, as population continues to grow, demand for agricultural products are going to continue to grow. Nutrien's dividend is supported just by the retail business alone. So any growth in commodity prices is just a bonus for us, or just, accretive growth for us. So, while this is positive on a short-term basis and could lead to, potential increases in potash prices, I mean, we're happy to own Nutrien just on the retail segment alone.
So this thing is kind of a bonus. Yeah.
For us.
Right, yeah, exactly. Yeah. And then finally, Aecon, is that stock ever hot? I see RBC hiking their price target to 25 from 17.
Well, it's interesting, and we've owned it through the hard times, which you could see, a year ago, and now we're owning it through the good times. And I think this is a good example of patience paying off. I mean, we were buying into it when the dividend yield was around 7%. They had some hard times through the pandemic as a lot of their legacy fixed price contracts were delayed through the pandemic. So the LRT, the Gordie Howe Bridge, and the Coastal Gas Link, which is now finished. But they suffered through a lot of these cost overruns for these fixed price contracts, but they never cut the dividend through the bottom. So, they obviously saw the light at the end of the tunnel where investors maybe didn't see that. And so now you look at it, they're in a position where those legacy contracts are mostly behind them. I think they're supposed to be settled, most of them by 2025, so next year. You look at their backlog, it's bigger than it's ever been. I believe it's about $6 billion, $1 billion in new contracts, just like they announced just last quarter. And there's no, speculation in terms of further write-downs for those legacy contracts. So I think some of the shorter-term investors are looking at this now saying, wow, this is really attractive, especially considering it's trading at a much steeper discount than some of its peers like Bird Construction. So we've owned it through the bottom. I think this is a good this is a good story. Just to just because the stock is down now doesn't mean it's going to be down forever. As long as it's not cutting the dividend, it's continuing to do what they say they're going to do. And we owned it from a 7% yield. Now it's less than 3% yield. And so we've collected that income along the way, and now we're benefiting from the share price.
And you've locked in that 7% yield.
Yeah,
Exactly. Always nice. Rebecca,
Yeah.
Thank you very much indeed.
Thank you so much.